Well, I guess the interesting thing to say about this juncture is that often Fed watchers will say, well, it's pretty clear how individuals are lining up. We just need to see how the votes come through on the committee. But I suspect right now, each individual member of the FOMC probably doesn't have perfect visibility about what they think they need to do. And I guess that probably does bring us back to the banking crisis in the sense of how much of the Fed's work of tightening is actually going to be done for them by the private sector. And I suspect even individuals don't have a clear path on that. So I think it's actually really hard to say. I think what we can say is there was more tightening needed. Some of that may come through the private sector. It's not unreasonable, I think, for the markets to have discounted a peak in the tightening cycle followed by reductions. But of course, that's consistent with either rates stay stable for a bit or they fall quite sharply, depending on how the credit cycle plays out.
Just dwelling on the banking crisis, obviously Jamie Dimon released his 43-page opus to staff in his annual letter overnight here. And he is still ringing the bell on this banking crisis and saying it is not done yet. There are further issues down the pipe still to come, unspecified. How much note do the markets need to take of an insider talking down the banking sector?
Yeah, it's a really interesting comment. And I guess the question would be, why might he have a different viewpoint from the one that investors should have? And I think one of the key questions here is, could you have issues that are important but not systemic? And I guess in the context of a company like JP Morgan, what you would be thinking there is a lot of their work kind of gets really down to the ground level, small companies, households, and challenges for credit there are ones that he wants his staff to be looking out for, quite right too. But they're not necessarily ones that affect the top end of the capital markets in terms of the big companies that are driving index performance and so on. So I guess the question for Jamie would be, are you talking about what you want your underwriters to do or what you think is going to happen to the share price? And I think he'd probably say A.
Just on risk generally, how constructive are you on equities and equity markets, given that, as we were discussing earlier, the mood seems to be shifting away from recession to skirting recession, and you're actually seeing in some quarters the analysts beginning to mark up their expectations on earnings, which I never thought we'd see at this point in the year.
Well, I guess one of the first kind of textbook lessons that investors learn is you should be looking to invest in the stock market at the time when you're emerging from recession. And maybe emerging from recession fears has a similar kind of effect, but we're less inclined to notice it or to believe in it. So this has been a very unloved rally so far. But actually what we're seeing now is, as you say, the fundamentals are being revised up a little bit from very severe markdowns that we saw at the end of last year. Volatility conditions in the market are normalizing. And while there is this big question about how the credit cycle will play out, that's not quite the same as an immediate systemic risk in the banking system. And I think investors have had quite a bit of time to digest what the potential outcome could be on the credit side. We would expect the central bank to respond. So you put these things together, and I think probably the surprise for investors could be that this rally continues for further rather than we come to the end very quickly.
And just to be clear, when you talk about the rally, that includes the rally in equities. And I just ask because, a lot of investors would argue that valuations look a little bit stretched here. And even if we do see earnings upside, to Jeff's point about that prediction becoming a little bit more popular as of late, it's hard to understand what the catalyst is going to be for further upside in equities.
Well, I think we're at a point when the real kind of source of instability in terms of people trying to weigh up multiples versus earnings has been the earnings expectations, and therefore I think some stabilization there, and as Jeff was saying, maybe even some improvement is something that could actually allow people to get comfortable, maybe not with valuations across the piece. We may see particular pockets of readjustment, but I think what the market has shown is a willingness to look at expensive parts of the market as a rotation rather than as something that creates a headwind for the entire market, and I think that's a pattern we could see continue.